Our next guest says the real surge is yet to come. Chris Verrone called the breakout when he was on the show a couple weeks back. So, Chris, where are we headed from here?
Hey, Mel, I think we're headed with yields going up still. And I think what's important about this move, it's not a few days old. It's a few months old. Bond yields bottomed in late June, early July. The trend here is several months old. I think any short-term pullback in bond yields into the 85 to 90 basis point range, that would be an area to be a seller of bonds. We think ultimately yields can go up from here. And if you look at the longer-term chart of 10-year yields, you have to really focus on where yields bounced from in 2016 and where they broke down from in 2020. And when you look at this move here, I think 130, 140 is ultimately where this is likely to go. That's where those key levels are. I think importantly, as bond yields have gone up, the yield curve has also steepened here. 2s and 10s are pushing 80 basis points. And I think equity leadership changes along with that. We've talked about regional banks here before. I think that trend continues. The KRE here is starting to break out, not just relative S&P, but on its own right. The 50-day in the KRE is now up through the 200-day as well. So the technical is starting to improve here as well. And I think ultimately you have KRE pushing 59, 60, 61 over the next number of months. I think the stocks you want to play here, if you look within here, Regions Financial, RF, one of the better looking names in this group. I think this speaks to a steepening curve. I think it speaks to higher yields. None of these are new trends. These are stories that began months ago. I think they continue now.
Chris, I want to underscore the levels to which you think yields will go. Much higher from here, correct?
Yeah, I think 130 to 140 are the levels to circle here. These were the big levels both earlier this year and in 2016. This is where you broke out from. This is where you broke down from. Think about this as gravity pulling yields up to that level. I think ultimately the bigger story is not yields themselves going up. It's the curve steepening. 2s and 10s have decisively broken out. This is a 3-year high on 2s and 10s. Leadership changes with that. I think it speaks to an environment where the banks can do a lot better.
All right, Chris, we're going to let you go. Thank you so much.
Thank you.
Chris Verrone. Now, we start off the bat with Chris, which is a departure from our normal for the show, because if Fast Money were a movie, that would be the scene setter. Because higher rates is the prism through which we need to view the markets at this point, Guy. So in a world in which rates go to 130 or 140, what does the stock market look like?
It's like a Tarantino movie, right? And by the way, is he in the booth right now?
No.
Is that why we did this? Because I happen to know he's a huge fan of Fast Money. I digress, clearly. Where do you go? So first of all, you have to know what your line in the sand is. And, you heard Wilf and Sarah talk about the bond market being closed tomorrow. And that's fascinating because we're at a critical point. In terms of the TLT, 153.16 was the low, I think, on June 5th. That probably coincided with 95 basis points or so in the 10-year. That's your line in the sand. I happen to think we're going higher in rates, lower in the TLT. And you can go to the banks, and we can talk about that, or you can go to Tim's resource trade that's been on fire. FCX, Freeport McMoran traded over 21 the other day. It's pulled back. I think all those names still work. So although the banks have room, I do believe, and we can talk about Citi still being cheap on a price-to-tangible book, I think the place to be is resources, Mel.
It has been an extraordinary week so far, and today is just Tuesday for the regionals as well as the S&P financials. And S&P financials up 8%. KRE, which Chris had mentioned, up more than 16%. I mean, these kinds of moves are like the moves that you would see in Peloton or a Beyond Meat in a single day.
Yeah, and I think you've got a case here where the banks will go higher, both on valuation, some sense that they were a lot more conservative in 3Q. In other words, they didn't have as aggressive of the loan provisions. In fact, a lot of them rolled off. You got some sense that credit is at least we have a better sense of it. And it is important to talk about yields today, especially on the day we had the largest 10-year auction of all time.
Yeah.
$41 billion was auctioned, and it was very, very soft. And this is after yields had moved from 50 basis points in August to 96 going into this. So you should have had good demand. And it underscores another issue, which is that there's a ton of supply coming out of the Treasury market. And I think rates are going higher, too. I don't think they can get too far away from you on the upside. But remember, we're at 160 on the 10-year in February going into COVID, and we started the year at 2%. So even if we got some sense that we are pulling out, and even if the vaccine takes a full year before we get back to some normalcy, who knows? Yields should go higher, and ultimately equities will respond. BHP, Rio Tinto, Guy talked about Freeport, but this resource trade, Glencore, which is probably as levered to higher rates as anybody, was up 4% today, and you should follow these trades.
Grasso, I want to get your take, and I don't think that we've spoken since before the election, so kudos to you for getting the rotation right in your positioning of your portfolio in terms of chemicals and some of those industrial names. Where do we go from here in a world in which rates push to 140 and the yield curve steepens?
Yeah, so I think you have to stay with financials. Obviously, I'm staying with those diversified chemical plays, with the paper plays. I'm rotating out of technology. I'm staying where I am. But if you look at it, as the guys were just saying, J.P. Morgan is up 24%, 7 days. Citi up 21% in 7 days. Goldman up 16% in 7 days. Now, if you look at the 10-year, just on a yields basis, as Chris covered, it's up on a percentage-wise, it's up 35% in 3 days, over 90% in 90 days. So you have to stay with the banks. Everyone bet against them. Now you have to bet on the banks, industrials, banks, chemicals. That's what I would do, and that's what I would continue to do. Now you have to remember, it feels like we're long in the tooth with this rotation. It just started. This is a 20-year unwind. So I think that it's going to take much, much longer. Are we going to get 20 years? No. Maybe a couple of years. I think you're going to see a gross outperformance by value, and that's where people who are watching the show should be putting their money right now. Selling their technology plays, going into value plays, start with the banks, and then trickle down from there.
Pete, you're a tech guy. You pairing your exposure there, and how do you feel about the banks, especially given the Biden administration? Depending on what Treasury Secretary we get, we could be staring down the barrel of tighter regulations on this sector.
Yeah, Mel, I'm not so concerned about the technology names. As a matter of fact, I have not sold one of the ones that I'm exposed to at this point in time. But I do agree with the guys about the material space and specifically the banks. I mean, Mel, all you've got to do, and I think Steve just laid it out very, very nicely in terms of J.P. Morgan, the performance that we've seen out of Bank of America, all these stocks across the board, including many of those regional names. I'm very happy about it. I've got a lot of exposure to the banks. I was one of those people getting pretty frustrated and didn't know when we were going to see some of that performance, especially after the earnings season. And we heard how good so many different parts of the banks were, just not all of the parts. Well, they're going to start to see a little bit more improvement, especially if we get to Chris's targets of I think he said 130, 140, something like that for the 10 years. So I think that really does bode well for the banks, the regionals. All of them should perform. And many of these names, Mel, not only do they give you the yields that they give you, but on top of that, we have had incredibly high volatility to be able to sell against these positions. So it really has been a place to be, I think, even when we haven't had the performance. Now we get the additional performance side of what's going on in the financials, and this really does give you an absolute home run, in my opinion. The J.P. Morgans of the world, if I can sell options against that and get my dividend yield and get a little bit of performance from the stock, which we haven't been getting because we were so stuck at $100 a share for so long, this is absolutely something that I look at as a home run.
So, Guy, does this mean that we should be expecting better economic growth on the horizon if we are to believe that rates are rising to 130 or 140?
Yeah, I think most people would say that is the case. I'm not certain that's going to be the case. I think rates can rise for that reason, the right reason, or they can go up for other reasons. And I think we're sort of in the other reason camp. But if you do get, if there's some chance of getting a stimulus bill through in the early part of this new administration, assuming that's what's happening here, I think that could lead to at least some hope for economic growth. But again, we're coming into a really dangerous period in terms of the virus, in terms of the season. I am hard-pressed to believe you're going to see the economic growth that's commensurate with this bond move. And that's going to create some problems, I think, maybe for the S&P 500. And that's one thing I think you have to look at very closely in terms of why yields are going higher. I happen to think they're going up for the wrong reason.
Should we care what is fueling this rise in rates, Tim, or is it good enough to know that they are going higher and that is how you invest?
Well, when rates got down to 35 basis points during the lows of the crisis, that was disturbing on many levels. So I would prefer to call this rates starting to normalize. And we know the environment we've been in for the last four decades, let alone the last 4 years, as central banks have we've used the term tool shed, The bottom line here is that rates are going higher for a handful of reasons, and they include deficit dynamics, they include issuance dynamics, they include the early stages of a recovery, even if they are not upon us, will be priced in before that. Make no mistake. In some sense, even though the Fed is not going to go near this, that the Fed at some point could be backing off of uber accommodative, again, not in the short term, but rates are going higher for all of those reasons. And interest rate sensitive sectors, whether it's energy, whether it's utilities, whether it's resources, whether it's banks, have been rallying not just for the last couple days. In fact, they've been outperforming for probably, a month and a half.
Shepard Smith here. Thanks for watching CNBC on YouTube.